Hello all, welcome to our series NFO series where we speak to the top fund management teams of the top EMCs who are bringing their new fund offers into the market. Today we have with us Akshay Udeshi, the ETF fund manager for Mirae Asset. He has been with Mirae since June 2021 and has been with them over 3 years now. And he is the fund manager for commodity and equity funds, handles product and fund management for their index fund and ETF teams. Welcome, Akshay. Welcome to the talk. Good to have you here. Maybe before we actually start getting understanding what these index funds are, and about our about the product, the NFOs itself. Okay, I want to understand that how does the investing in index funds compare to the actively managed funds in terms of potential returns and risk for retail investors? I think that's the very first question that comes into mind. That how does investing in index is different, better or worse? We'll not discuss, but different from investing in actively managed funds.
Sure. So so let's try to understand this from the very basics. Okay. So if I divide investing broadly into two buckets, it would be active investing and passive investing, right? In active investing, you have a fund manager, which will try to pick up some companies and try to outperform the benchmark. Your benchmark can be Nifty 50, Nifty 500, as per the market cap segment that you're investing. So the advantage over there comes that you will be having the potential to outperform the benchmark, but at the same time, there is a risk of underperformance as well. And India is, such a dynamic market. So there's no single fund manager, which can consistently outperform the market continuously. And if we just look back at the history, if I just talk about the last 15 years, you'll never find a fund that has continuously beaten the benchmark. So the performance of active funds is very dynamic. It keeps on changing. I'm not saying it's bad, but it keeps on varying. And as these markets get mature, outperforming the benchmark gets more and more difficult. And as India, we are an emerging market, right? We tend to follow the developed markets.
Correct.
The same trend was observed in US when there was underperformance in the active funds, and then there was the rise of passive funds. Just to give you a small number, back in 2005, the passive funds in US were just 12% of the total AUM. And just let me jump to 2024, they are above 50%. So you can see the shift that has come towards passive funds. And when I talk about passive funds, why are they good, and why people are so much interested in investing in that particular segment? It's because of two simple reasons. The first thing is that you are removing the human bias. You're removing the risk of underperforming the benchmark. You're simply getting the benchmark returns. And since it's a rule-based approach, your portfolio is automatically rebalancing. Like I'll always say, let's say if you as an investor are more tilted towards bank, and I'll say no, IT is going to do better. So one of us is going to be correct, but one of us is obviously going to lose because one sector would outperform. So at a high level, your passive funds do the rebalancing automatically in your portfolio. You don't need to, manually adjust your portfolio. The market would automatically use a rule-based approach, and your portfolio is adapted to that changes. So there come these passive funds where your risk of underperformance has been eliminated. And as market gets more and more mature, and the information flow becomes more easier, the passive funds are definitely going to perform the active funds in the future. And the SPIVA report that shows the performance of active funds versus passive fund has shown that trend, that on a 10-year basis, on a 5-year basis, you'll find more than 70% of the passive funds outperforming the active funds. So the trend has been just not followed in a country like India. It is a global trend. And going forward, as market gets more and more efficient, your passive investing is going to rise. And at the last, there's one point where your active funds regular plan can cost you 2%. Your passive fund starts with an expense ratio of as low as 5 bips. So you can see the cost difference, because in the end, the cost drag is also going to impact your returns.
Yes. Oh, I think that's a wonderful start for this conversation. I mean, we got this the big elephant out of the picture, that active fund or passive fund. Now let's let's jump back to the main, the main topic here. That is the three NFOs that are coming here. Okay, that is the Nifty 50 index, the Nifty Large Mid Cap 250 index, and the Nifty Total Market Index funds. Okay, so can you give me, can you explain the investment objective of these three funds, three new funds, and how they align with the different investor rules?
Sure. So, I'll start with a very interesting case. So let's go back to 2014. Okay. And it's October mid, right? And at that point of time, October 2014, Nifty was trading around 8,000. Okay.
Yeah,
And let me just ask you the current levels. You'll say it's 25,000. So
25,000. Yes,
markets have risen 3x in terms of absolute basis if we talk. So that's a 3x rise. And why is that rise, like why it has risen so much? There are some underlying reasons for it, and the reasons is the economic growth that we have witnessed in these past 10 years. Our
correct.
export numbers that used to be 14% in 2014, now they are at 22. Our GDP per capita has improved. Our forex reserves have improved. So overall, India has been witnessing that growth story, right? And if you want to bet on India, right? Currently, we are the fifth largest economy in the world. And as per IMF World Bank estimates, you'll see that India is expected to become the third largest economy by 2028 to 2030. And if you want to bet on the story of India, there comes our first fund, that is Total Market Index Fund, which gives you exposure to the entire market. So as the name suggests, total market, it's giving you exposure to 750 stocks listed in India. Yeah, you heard it right. It's 750 stocks in one single portfolio. So any investor who, like he's a newbie investor and is looking to start, he wants to start his investing today and saying, oh, what kind of product I can look. I say, if you're positive on India, you believe that this emerging market is going to grow further, I think that is the product that you have to bet on, and that's Total Market Index Fund. It's giving you exposure to large, mid, small, and micro cap segments of the market. So that's the first fund. If I talk about the next fund, okay, and when I say small and micro, yeah, the returns part obviously excite us, but there's one thing, risk comes as well, right? When your markets do correct, your small caps, mid caps would obviously correct more than the large cap.
Correct,
So
correct.
for a lesser risk profile, if you are not comfortable investing in let's say small cap or micro cap companies, there comes a relatively more stable portfolio, and that is large mid cap 250. So as the name suggests, large mid cap, it's going to invest 50% each in large cap and 50% each in mid cap. So it's giving you
Mm-hmm.
a balanced exposure to both the large cap and the mid cap segments. And when I say balanced experience, because as India is growing, companies are growing, your mid cap companies are also equivalent to your large cap companies in the coming future. So if you are looking for a balanced profile, as well as don't want to lose out on the returns, because mid caps have been the best performing segment in the last 10 years. So there comes mid cap, you get a balanced, stable portfolio, as well as you don't miss out on the alpha that is being created in the market.
Correct.
And
Correct.
lastly, if you want to, like, if let's say I started investing today and I want to look for a very safer product, right? I want to just start investing. So what do I start with? It's Nifty 50. So you'll see
Mm.
Nifty 50 is the most highly traded tracked benchmark in the Indian equity markets.
Correct.
So let it be any FPI investor or FII or DI investor. So the first bet to start investing in market comes from Nifty 50. And Nifty 50, as the name suggests, it tracks the top 50 blue chips of India. You'll be seeing popular
Mm-hmm.
names like Reliance Industries, ITC, Infosys. So all the blue
Correct.
chip companies that we have known since the past 30 years do come under this category. So Nifty 50 is the most less risky product out of the three. But as I say, each product has its own speciality. Because when
Yep.
I say of total market, you get the additional alpha because you're investing in mid, small, and micro. In large mid cap, you'll have a safer profile, more stable profile. The volatility would be lesser. And finally, is
Correct.
Nifty 50. Like out of all the three, it's the most less risky. And again, it's the go-to product for investment for any institutional or retail investor today.
Correct. Correct. Okay, so I think so. The next question that I have is that for the Mirae Asset Nifty Large Mid Cap 250 Index.
Yeah,
Can you elaborate on how the balance between the large cap and mid cap stocks would impact the returns and the volatility?
sure. So, at this point of time, like when we say markets are like have risen a lot, right? And small caps have seen that kind of rally in that past year. And when I say of like particularly talk about small cap, you have young and niche companies playing out there, right? Companies
Mm,
who have to yet prove their business models.
correct.
So
Yes.
small cap is a high risk reward game, right? So you'll be having higher reward, but in the end, you are having the higher risk over there. So that's the reason we came with the large mid cap 250. But as
Hmm.
investors, we are always hungry for alpha, right? We want that
Yeah.
extra alpha, extra kicker in our portfolio. So that's the reason we have large mid cap. And our intent is to create this product is that you get an equal exposure to large and mid cap. And
Hmm.
even if you see the top mid cap companies,
Hmm.
you'll see all the big names over there. There's Power
Yeah.
Finance Corporations. You'll see all the big companies. You'll see Suzlon from Renewable Energy, which has been in the news since the past 1 year. Then you'll see Bharat Electronics, HL. You'll see a mixed bag of all the leaders, typical industry leaders in this particular portfolio. So the large mid cap 250, it's giving you a very balanced profile between the large and mid. Okay, like you want that additional alpha, we'll give you that. Yeah, and the risk profile would be also lesser because large caps adds to your stability in the profile.
Correct.
And whenever there is a market distress, right? Let's say Russia-Ukraine war, COVID, or the
Yeah.
subprime crisis back in 2008, right? So large cap was one segment which had always cushioned from that fall, right?
Hmm.
So at that point of time, the large cap part adds stability to your portfolio. You get a very balanced experience. You don't miss out on the alpha even your
Yeah.
portfolio doesn't correct well. So that's the reason we chose large mid cap 250 for those investors who want a 50-50 exposure to large and mid cap companies.
Okay. I think so. Then I mean, you briefly touched upon the factor that how these funds, are better for each type of investor goals. Uh, what, especially if they are looking for a long-term wealth creation? I think that's a very, as a mutual fund, as a product, we always, sell or rather pitch a long-term wealth creation. Uh, Sorry,
Yeah, yeah, yeah. I was able to hear you. I got your
Okay, great.
question.
Okay,
Okay.
sorry. So I was saying that as a mutual fund as a product, we always pitch in the product as a for a long period of time, 15 years, 20 years. So how do these index funds will play a role in their portfolio?
Sure. So when I say like just going back to the previous conversation that we had, like there's no single fund manager that has continuously outperformed the market. And second fact that a large number of active funds find it difficult to outperform the benchmark, right? So from a long-term investor, you would be always concerned about the returns that your portfolio is creating, and secondly, the cost, because the
Correct.
cost is like it's even if you lose 1% on the expense, you are
Yeah.
that 1% compounding would be big, right, in the long
Yeah,
run.
yeah, yeah. It would be, yes.
So at that point of time, I believe that passive funds, the first advantage is the relative low cost that comes.
Hmm.
Second is your portfolio is automatically getting rebalanced at any point of time. So you don't have the risk of adjusting कि आज बैंक अच्छा perform करेगा, IT करेगा, कि capital goods करेगा, कि defense करेगा, right? So your there's risk mitigation that comes through these passive funds. And I'm
Hmm.
not saying you don't invest in active funds. I'm saying that have a balanced profile. If you want to create a core portfolio today, you want to make some strategic asset allocations, so look for some core products in your portfolio. And what are these core
Correct.
products? So let's say if it's of my first day of investing today, okay, and
Hmm.
I ask you like what kind of product should I look on, so you'll be very concerned about this thought, right? Like whether it should be a sectoral thematic. So
Yeah,
I'll
yeah.
say that
Absolutely.
better have a all cap exposure, get
Hmm.
invested into every part of the market. And if we believe that India is going to become the third largest economy, like just for everyone's record, India is currently the fastest growing emerging economy in the world.
Yes, yes,
So,
yes.
and go, if we talk about 10 years ahead, as you said, the long term, a typical
Hmm.
long term wealth, a long term horizon that we talk about,
Correct.
there may be more instances of positive calendar year returns than negative. So, you're
Correct.
on the long run, you are expecting that markets are going to grow. India's GDP is also going to grow. So, your index funds become a very good route. And one
Correct.
product that I will typically emphasize over here would be the total market index fund. You are not biased, right? You're getting an exposure to large, mid, small, micro. Like any of the market segment would perform, your portfolio will. Any of the sector would perform, your portfolio would grow.
Correct.
And even
Correct.
if any sector is down performing, the portfolio will automatically reduce the weight or even exclude that security that's underperforming. So,
Hmm.
like back in 2017, renewables was in trend, and we
Hmm.
didn't thought ki, like whether I should invest in a renewable, or we were like scared ki, yeah, whether this trend would fly up. And the same follows for EVs, right? We were,
Yeah.
first of all, we were very like we were discordant ki, no, this particular trend won't fly. People are going to just rely on ICE vehicles, petrol vehicles.
Correct. Correct.
But here we are seeing EVs growing like anything today.
Yeah.
So
Yeah.
at that point of time, if market believes that EV is going to do well, it will automatically, your total market index fund would automatically include those EV companies, because it's trusting the market.
Hmm.
What is
Hmm.
the what which market cap is growing? So obviously the company that will grow would automatically get an allocation in this particular portfolio.
Yeah.
So if
Yeah.
you're looking for an all weather portfolio, I think total market index fund is one product that you should definitely bet on.
Yeah, I think there are. I think you answered two of my questions here in bits and pieces. So I would like to you to
Okay.
elaborate a little bit more. First is the frequency of these portfolios being rebalanced. How frequently will the portfolios of these index funds will be rebalanced, and is there a methodology behind it? That's number one. And the second question I would like you to you briefly touch upon is that having a total market exposure. Okay, how does that benefits investors more than having a concentrated exposure to a particular index?
Sure. So if we go by the index method, so I'll just talk about total market as you mentioned the name. So
Correct.
total market index is a 750 stock portfolio. You have top 750 stocks like created from Nifty 500 and Nifty micro cap 250. Out of them, 100 are from large cap, 150 are mid cap, 250 are small cap, and 250 are micro cap. If I tell you what kind of exposure you get close to 70% large cap exposure,
Mhm.
18% mid cap, and rest is small cap and micro cap. The portfolio is rebalanced on a semi-annual basis. When I say rebalanced, so you will be having on a semi-annual basis, there would be changes that would be made in March and September. So you'll be seeing a lot of securities that are going out. The ones that would be underperforming would go out, and ones that are performing well would stay in the portfolio. And the
Correct.
new ones would get included. And there are weight research on every quarter.
Correct.
And lastly, as you said, like if any particular investor is taking a concentrated bet, okay, let's say you take a small cap bet, I take a mid cap bet, or let's say I take a large cap bet. Let's talk of two extremes. So 2023 is your year. Why? Because small caps performed well. It
Correct.
was 49% was small cap and 21% was large cap. So you won over there. Let me go back to a year in 2018. Markets corrected, banking crisis, ILFS crisis, right? You saw housing finance crisis.
Yes.
Large
Yes.
cap performed well, small cap performed bad.
Perform.
So at
Yeah.
that point of time, in that particular year, you were the winner. In this particular year, I was the winner.
Correct.
But when I'm saying that on a long-term base, I want a stable portfolio, right? I don't want
Hmm.
to just keep migrating from two extremes, right? Like
Hmm.
just I can't just move like a pendulum from one place to there.
Correct.
And
Correct.
that
Correct.
comes the total market, which was neither first, neither last. So you get a balanced risk return profile. You're not concentrated towards any large cap. So last year, and you can just see 49 and 21, the gap is so big, right? So at
Correct.
that point of time, you are missing out on I was missing out on the alpha because I was not invested in small cap. And at the same
Correct.
time, when your portfolio was correcting in 2018, my portfolio wasn't correcting. So
Yeah.
from a long-term basis, it's always healthy to have all cap exposure, have a
Yeah.
balance of everything. create
Yeah.
stability in your portfolio, and at the
Yeah.
same time, don't miss out on the additional alpha that's been created.
Okay. My last question with this is that with index funds, is there a risk of over diversification?
See, when we say index funds, okay, so see, it's also there's again two ways of looking at it. Uh, as I said, let's say if I was I was creating my portfolio back in 2018, the same example that we talked. So at that point of time, we typically as investors see what kind of business numbers are there. Okay, like see this business is growing, it's showing profitability, right? But at that point of time, did an EV company had any kind of profitability? Does a solar company has any kind of revenues back in 2018? Even if it was there, it was very minuscule, it was very small, right? So at that point of time, I will say no, yeah, this business is not it's not doing. There are no numbers backing it. There are no fundamentals. There may be a story, but I may be reluctant to invest, right?
Yeah, yeah.
So at that point of time, you will say, no, I don't want this particular thing in my portfolio. But again, market believes it, so it would be automatically coming in your passive fund. So there you lost out on the additional alpha. And I always say that having a diversified profile is good. And the best part about passive funds is that you are not just limited to, just specific companies. You have a horde of companies. You have 750 companies.
Correct.
And out of those 750 companies, you are giving more weight to those companies whose market caps are growing, right? Let's say if Reliance is having a market cap of 9 lakh crore today and its weight is 9%, hypothetically. If Reliance performs well, right, and the stock prices grow and market cap goes to 10 lakh crore, automatically you will get that 1% increase in your portfolio change.
Absolutely.
Your portfolio also gets that you like when your portfolio is growing, you will also see that weight of Reliance also growing in your portfolio. And at the same time, if Reliance was underperforming, market cap would have fallen, so your weight is reduced. So you are typically betting on a time tested strategy that has worked since 1970s, right? When I'm saying it's not a single market like India, it's across the world. Let it be Europe, let it be US, let it be China, or let it be India. The total market strategy is like a all-weather portfolio, and it has a very balanced profile for you. You like again, you are diversified, but when I say is India going to become the third largest economy? And if we believe so, I think total market exposure is a good thing to bet on.
Okay. Okay. Thank you, Akshay. Thank you so much for your insights. I think they were really wonderful. I think I learned a lot. I think I should be adding index fund into my investment list. So thank you so much for your insights. Let me just quickly remind our viewers the NFO periods for Mirae Asset Nifty 50 Index Fund. The NFO opens on, it opened on 10th of October 2024, and the NFO closes on 18th of October 2024. The scheme also reopens for continuous sale and repurchase from 25th October 2024. Similarly, for the Mirae Asset Nifty Total Market Index Fund, the NFO opened on 8th of October 2024, and it closes on 22nd October 2024. Also, the scheme reopens for continuous sale and repurchase on 29th October 2024. Thank you so much, Akshay. Hope to speak to you soon on more such interesting topics. We'd like to get to know more about the indexes, index funds more, ETFs more. Hope to catch up with you soon. Thank you so much.
Sure. Thank you all. Have a good day.
Thank you so much.
Thank you, Akshay. Thank you, AssetPlus team.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.